My name is Nick Krautter, and I'm the CEO of City and State Real Estate. And I'm really excited to talk to you guys today about what's going on in Portland. So we're going to dive right in. I wanted to leave some time for Q&A and to make sure that we had a chance to have a good discussion. Definitely have a lot of questions coming in. If you have a question, please put it in the chat so I make sure we can cover it at the end. And I'll hopefully answer a lot of your questions today in the presentation, but if we don't, feel free to, at the end, take off mute and ask questions. So I want to talk to you today about what's going on in Portland real estate, and want to start with some of the headlines we're seeing. So Willamette Week came out with an article this year talking about migration patterns and how that affects tax revenues. Now, this isn't affecting property taxes because obviously the real estate stays, but people's income taxes. And City of Portland and Multnomah County now have, it's technically the second highest tax rate in the country, only to New York City, but the highest tax bracket in New York City is 25 million. And in Portland, once you're over 250, you start getting a lot of the bonus taxes for childcare and homeless support taxes. And so the bottom line is, over the last couple of years, in 2020, every city lost population pretty much across the country. People moved to the suburbs, they moved home. And we're seeing now a trend of most cities, people are coming back, but unfortunately for Portland, we're still losing population. And our state economists just came out with an article saying it's 3-alarm fire right now, but it could be 5 if in 2023 we also lose population. Now, the positive is still that we're way more affordable than San Francisco, San Jose, Seattle, LA, San Diego. So in terms of West Coast City, we're still maintaining our place as the most affordable place to go. So this new governor, Tina Kotek, they have committed $200 million in 2 different bills for rent assistance, shelters, and housing. Now, how that's spent and how quickly it's put into play remains to be seen. This should help stabilize the rental market, though, giving more support for people that are struggling economically, that need help with rent payments. So on the public side, there's a good amount of funding going into real estate, including creating incentives to convert office to residential. Now, I've talked to quite a few of our developers about if they're doing this. The Schlesinger family is, in the Portland Business Journal today, is supposedly going to be pulling a permit to convert a couple floors of one of their office buildings. There's a fantastic article also in the New York Times about the kind of the nuts and bolts mechanics of how a conversion works and what types of building it works best with. Unfortunately, the easiest buildings to convert are the older buildings that have more windows that open and that have smaller footprints, meaning they're skinnier. So there's less square footage per window versus a building like Big Pink or a modern office building, which has a ton of space in the middle with no windows. Those are more difficult. And I was talking to one of the top office brokers in the city about if his clients are looking at doing this. And the problem is that in Portland, our downtown has been languishing. In fact, it's rated as the lowest vitality of a downtown in the country right now, in a report that the Business Journal just put out, ranking Tampa, Florida as #1, and Portland, Oregon is the very end of the caboose of the train, unfortunately. And so where are those office buildings? Well, they're in downtown. And I don't think there's going to be a lot of market demand for those spaces, at least until we see a return to downtown, a return to office, and some vibrancy. Unfortunately, from my perspective as a real estate professional and someone that provides housing to a lot of people as a property owner, the state is trying to further tighten rent increases and increase penalties to landlords when they move a tenant out. Now, when I started doing real estate way back in 2006 in Portland, there was no rent restrictions. It was just market, and there was 30-day no-cause evictions. Now, somewhere between where we are now and where we were then is probably a very fair, reasonable solution that protects both the landlords and their investment in the property and operating a business, and the state's desire to protect people they see as being vulnerable. But if they lower these rent increases to 3% plus CPI with a cap of 8%, in a year like this, where we've seen natural gas prices in some places double, and you see costs of repairing and replacing heating and cooling units and roofs and labor double in the last 2 years, you could end up in a position where your rent increases that are allowed by law don't even keep up with the costs of increases in expenses. I mean, keep in mind that property taxes can increase at least 3% a year. That doesn't include bond measures, which in Portland there typically are. The worst year for property tax increases that I recall was about 11%. And I want to say that was in 2015 or 16. So that can happen. And if you do that and you limit rent increases, you end up falling further and further behind, especially for the landlords that are providing affordable housing, which is such a bummer. Because they keep their rents low to keep turnover low, but then they end up in this quandary where their values of their properties are lower because they're not increasing rents enough to keep up and costs keep increasing. There's a lot of distress in downtown office. And I think that if you look at the real estate market as a whole, you have to really look at it in two ways. You have to look at it location, micro and macro, and you have to look at it as property type, and that's also micro and macro. But right now, where we're seeing the most vulnerability is in West Coast downtown office. In terms of the housing market, it's really interesting. I think it was CNBC put out an article today that from the middle of the country west, prices are typically stable or declining, and from the middle of the country east, from Connecticut to Florida, prices are still increasing. So you're seeing interesting migratory patterns. It isn't 100% to do with income taxes, because Connecticut actually has pretty high tax rate, similar to Oregon. So it isn't just that, but that is a big piece of where we're seeing migration happen and where businesses are moving. You may or may not have seen the article that Fisher Investments, which employs 1,800 people in Camas, Washington, Washington State just upheld a capital gains tax, and they Fisher Investments immediately announced that they're moving their headquarters to Austin, Texas. So we don't know if that's going to affect people there. I have a couple friends that work there. So I'm curious to see if that's more of a political move or if they're actually going to take a space there and move a portion of their workforce to Austin, Texas, like many tech companies have already done. So apartment sales, I hope this doesn't sound like a doom and gloom, because I don't mean it to be, but the apartment sales in Portland are on pace for a slowest quarter in a decade. And this is very simply a problem not with supply and demand. This is a problem with interest rates, because we've been selling apartment buildings in the 4.5% to 5% cap rate. And we were doing that because interest rates were in that 3 to 4.5 range. And so if your interest rate is lower than your cap rate, you've got positive leverage. That investment makes a lot of sense. But now we have the inverse. We have interest rates in commercial between 5 and 6, maybe higher, depending on the property type. But the cap rates haven't come up to meet it. And so what's happening is we have buyers and sellers that do not agree on prices. And this happens whenever there's a big shift in the market. But certainly it happens when you have a move this quick. We've never in my lifetime seen a move of interest rates go up this much, this quickly. And so it's essentially kind of shocked the market. And we're going to have this, whenever there's even a small move in interest rates, there's a kind of a cooling off period where there's a new water, a tide level that has to be reached for buyers and sellers to meet at the table and do a deal. And we're just not there right now. We're seeing a lot of activity in the affordable space. We're seeing a lot of activity in the value add space, and we're seeing a lot of activity in office and the owner user, and we're going to go into that in a little more detail. So let's talk about office. So quarterly office leasing volume. And you can see that obviously the lowest point was like during COVID, right? In the middle of 2020, when literally everyone had to go home and you weren't even going to the office if you wanted to. We saw a good recovery of that in 21 and 22, but now we're starting to see we're back down to the levels we were at COVID. And right now our vacancy rate in Portland is probably in that 30% rate. But the problem is the occupancy rate is only about 40. And so what that means is even though there's a lot of space that's leased, there is a lot of that space not being utilized. And so if you ask the owners of those businesses, are you willing to give up the space? Many of them would say yes, but if you have a solvent business and you've signed a lease, you're kind of on the hook. As a major tech company in San Francisco that just paid $90 million to break their lease on an office building. They had 3 different buildings in downtown and they're consolidating into one. And so, you know, probably the worst market for office is San Francisco because it's driven by tech, and tech has had a pretty bad recession in the last year or so. Portland is a little bit more of a diverse downtown office user base. It's not all tech. Although we do have that, but we're seeing consolidation. And again, higher interest rates. This is probably where there's the most vulnerability in the economy is commercial loans, because the loans are based on the asset value, and that asset value is based on what is your net income. And if your building is half full, even if it's all the leases that are there are performing, you end up with a building that's losing money. And so there's going to be issues as businesses, these office buildings have their loans come for renewal and they don't have enough income to support the loan. So they'll either have to bring equity and put more money down essentially on the property to refinance it, or they're going to have to sell it, or in many cases, the bank will take it back. I've heard we're about to see one of our first office foreclosures in Portland, and that they're expecting to lower the rents dramatically on that building to get it leased up in full. On the positive side with office, we don't have a lot of office under construction, and so it's not going to create more space. We're probably going to be dealing with the space that currently exists. So the big winner through this COVID cycle has been industrial. If you have a business that's been looking for space for production or for distribution or storage, you probably know right now it's very competitive, especially in those smaller 5,000 to 15,000 square foot spaces that are closer in. Price per square foot on the rents, if you look back from 2007 when I started in real estate, it was $6 a year, which is 50 cents a month, and now we're over, I think probably right around $13 or $14 a year, or $1.10 to $1.20 a square foot per year. And those prices continue to rise. I don't see any change in this. I know in a lot of markets, Amazon had overbuilt and they had stopped construction, or they're not filling up spaces that they had planned to use. But I don't believe that's the case here in Portland, especially Clackamas County has a lack of land for this. Clark County has a pretty small amount of industrial land available. And so we're gonna, I think, continue to see rent growth in industrial. That seems to be very strong. You know, we're working on some industrial deals right now. They're selling quickly. That owner user market is very, very strong. And let me go back here. That owner user market is very strong. And Prologis, which is noted here, is the biggest owner of industrial real estate in the US, and they are still bullish. They're still building new facilities. So if you remember the horse racing track, Portland Meadows, that's now Prologis Meadows, that is a multi-million square foot development that's, I believe, already full. Now, Portland historically has not had enough retail space. We've definitely added more, but it's mostly the retail underneath apartment buildings. It's been mandated in a lot of kind of corridors throughout the city. But historically, Portland hasn't had enough retail. The suburbs and rural areas are doing really well. We're seeing a lot of Portland restaurants and bars and businesses add satellites, and in some cases relocate entirely to the suburbs, and they've had great success moving to Lake Oswego and Tigard and Tualatin and Beaverton and Hillsborough. Those little downtown areas and their restaurant and retail corridors have been strong. Southwest Cedar Mill area has done really well. So we're seeing a lot of people that were, you were getting an Amazon delivery every day during COVID are now going back out and going to restaurants and going to stores to buy things in person. And so luckily they're not building a lot more retail. I think rents are going to moderate here just because of the costs that associated with everything else through the supply chain for restaurants and all that. So we saw, again, obviously during COVID was a dip for everything, the stock market, everything across the board in real estate. And then we saw a recovery later that year. We're starting to kind of see things kind of taper down in terms of retail leasing activity. So multifamily, this is a big piece of the market. We come off 2021, which was the biggest year. Just in the last quarter of 2021, there was close to 2 billion in sales in just 3 months. And so 2021 was the biggest year of apartment sales. 2022 was also very strong, but if you look over here at the very right, start of 23, it's about 160 million in sales, which is very, very low. Again, you have to go back to COVID to find a time frame where it was that low. And this period of 2017 was when interest rates had spiked from 3.5% to 4.5%, but then pretty quickly pulled back, and you saw the market took off again. So during the COVID year-ish, most places, including Portland, had prohibitions on rent increases. We removed that rent increase prohibition, and rents had gone up 10 to 15% in a lot of cases. A lot of times that was on new product or on new move-ins where someone had moved out of an apartment and moved in. We were seeing 10 to 15% increases in the rent. For people that were already staying where they were, the rent increases were not that dramatic if you look at the whole market. Now, I really disagree with this per unit sales price projection that CoStar has here. I think at least in Portland, we're going to have to see cap rates increase to a bit more parity with interest rates. And I know that rent increases are flat. We might start to see rent decreases, actually. A lot of our owners are saying that when they're doing re-rents, they're potentially have to lowering the rents. Now, we're finally into spring, so we'll see if that changes, but typically the winter's the toughest time to rent rent units. And so we'll see if this increases, and hopefully it does as we get into summer, that we'll see activity pick up. But the problem, I just don't see a lot of rent increases in Portland's future for the next couple of years. And I know expenses are going to continue to rise. This inflation monster is not going away just yet. It's not dead. And I think that we're going to see expenses for owners increase for every property type because of materials and labor, because of increases in utility costs and property tax increases. They all eat at the bottom line. And unless you're able to raise rents enough to make up for that, you kind of stand still or go backwards. And so net operating incomes, I don't think are going to rise that much. I think at best they'll stay stable. And I don't see interest rates on apartment loans coming down probably at least for like another 6 months until we start to see really clear signs that inflation has stopped. And unfortunately, we just keep seeing inflation numbers that are higher than expected and job numbers that are higher than expected, which is continuing to drive wage growth, which is driving inflation across the board. And so we should still see some rent growth, but I think in Portland, I don't think we're certainly not going to see as much as we've seen in the past, and it might be flat. So we've seen cap rates drop. So this cap rate drop that you see here, the green line, and it kind of matches up with the orange line. That's cap rates in the Portland metro. And, it's projecting here that they're going to stay stable. I just don't believe that's going to happen. We're seeing a little blip. We're already seeing properties in that 5% range. And I think we're going to need to be in that 5.5% to 6% range to start seeing activity, because you can keep cap rates as low as you want if you're a seller and keep your price as high as you want. But right now the buyers aren't buying. So what the buyers are buying is the value add, well-priced, low price per unit properties, many of them more suburban. And so that's where we're seeing a lot of this activity. But the new construction downtown core, the urban areas, say inside of 50th Avenue, I just don't believe that we're going to see 4.5 cap rates actually trading in 23, 24, and 25. I think that we're going to see this revert back to where we were closer to 2013, which is when interest rates were also higher. And that's just typically, I don't have a chart here to show you, but cap rates have to be above interest rates for the market to be healthy. And now the spread between the cap rate and interest rate expands and contracts based on how much risk people perceive. But I would say that now is probably more of a risky time than a less risky time, because there's so much exposure to interest rates right now, and people are really seeing how vulnerable they can be when interest rates rising really quickly and you have shorter term loans. We're spoiled in America that a lot of our loans are longer term duration, but most places like Canada and a lot of Europe, Australia, they have shorter term loans where they adjust every year or every couple years. New York Times had a great article, I think it was Sweden, their rates adjust every year or two. And so people who had bought properties with 0% interest are now paying 3%, which sounds great if you're comparing it to what we're paying here in the US, but it changes every year. And so you're more exposed to those rapid changes. So I want to talk about residential as well. A big part of our economy is new home construction. And it also reflects on what's going on with our apartments, and they're both housing, so detached houses and attached houses is all housing. So we're seeing prices in Portland starting to decrease. There's a little bit of a rebound. So here's our inventory numbers. You can see inventory started creeping up as interest rates rose this last year from about April until the end of the year. And we've had our highest inventory in January. What's interesting about this is that if you look at time on market, it's 35 days longer. That's double what it was a year ago. The thing that's keeping this inventory low is not that there's a lot of sales. It's just there's a lot of people that are choosing not to sell. And so there's not as much on the market. And the best way to show you that is to show you some trends. So if you look at February of 22 right here, and then February of 23, our pricing is down 2%. There's a little bit of a rebound between January and February, and I'm hearing from my residential broker friends that there's good activity and multiple offers still if the property's in good condition and priced right. Time on market's definitely higher. Things were selling in 21 days, and now we're at 71. But you look at this, our active listings, while higher than last year, is still declining, which is interesting. And I'll tell you why I think that's happening. New listings are lower than they were in the past. So again, less choices, but they're taking longer to sell. Pending sales also significantly lower, 1,000 units lower per month than they were last year. Closed sales also down. We were close to 2,000 units in January and February, and it looks like we're 1,000 and 1,400 this year. There's our market time, definitely increased. Our average and median sales price, you can see it was dropping down, and then in February we got a little bit of a bump, but we're still below where we were. And if you look at it, it kind of puts us back into the beginning of 2001. You know, where we started to see that post COVID panic recovery. And you see this huge spike in June of 22, and that's when all of the people that were rushing to get in on the low interest rates were in contract for a month or two and then finally closed on those sales. Average sales price is trending up, but it's still lower, and it's still negative. So this is a percent change of sold prices. You can see that they were going up, you know, 4 or 5% through the summers of the last 2 years, and we're now -2, -1. So we'll see if we get back to 0. I think by the summer we probably will. Price per square foot, you kind of see that we're between the last 2 years. Like I said, we're probably close to the 21 numbers. Now, this is really fascinating to me. For so long, people would move to Vancouver for a couple of different reasons. It was they retired and they didn't want to pay income taxes on their retirement. It was affordability. The houses were cheaper. You look in April of 20, median home price in Clark County was $375, and in Portland was $425. That's, you know, that's a more than 10% difference in purchase price. But if you go across this chart, you kind of start to see there's a trend emerging. The the median prices on both places has dropped, but Clark County has definitely stabilized more, and now in some cases is more expensive than Portland, which is really interesting because for as long as I can remember, Portland was always more expensive than Vancouver, and that's starting to not be true, which is interesting. And like I said, there's a lot of different reasons, taxes being a big one, schools being another one, and more of a small town feel, less homeless, less crime, different laws being a driver for that move. And we're seeing that showing up in the numbers of what people are paying and how values are holding. So active listings are still a little high. This is another thing that this is a good chart if you are looking at the future for rentals, and it's a tough chart if you're looking for the future of home ownership rates. So for so long, we've been the most affordable place in the West Coast. Now, for reference, if you look at like a chart of affordability in New York City, it's probably like 20. And what this chart means is what percentage of people who make median income can afford a median home. So when it's 100, like it was here, it means that 100% of people that make median income can qualify for a mortgage on a median price home. But now we're down and it's dropped. So we're in this 80% range. And that's going to be an issue for home ownership. Now, at the same time, we'll talk about owners getting stuck. So we're going to have, just like in the Great Recession, when people had loans that were more than their homes were worth, they were underwater. A lot of those folks who had good jobs and good credit, as opposed to letting the property go to foreclosure or doing a short sale, they just rented it out and just weathered the storm. And as the market recovered and their properties got their value back, they chose to sell them and recapture their equity, pay off those mortgages. But there was a lot of what they call unintentional landlords that got stuck with these homes because they were underwater in 2008 to 2013. But now we have like a different issue. People have a ton of equity in their real estate, but they also have really low loans. So they've got interest rates of like 2.5% to 4%. And they're thinking, well, geez, I'd love to move. Let's say you want to move from Southeast Portland to Vancouver, and you've got a nice bungalow down there. It's worth $700,000, and you've got a 3% loan. Well, that's great. You've got a lot of equity you've probably built up. You can go buy a house that's perfect for you and your household in Vancouver. But the problem is now you're going to get a loan for 6.5 to 7.5%. And you start looking at the numbers and you go, oh my gosh, 4% difference on a $500,000 loan is almost $2,000 a month. And so do we really want to spend that much more to get the same price home? Or alternately, do we leave our equity in that house and rent it because our mortgage is $2,500 a month and we could rent it for $3,500 a month? So maybe we should rent that house out and go rent somewhere else, or maybe we'll just buy, but we're not going to give up this home. And I think that's why we're seeing so few new listings hit the market. Now, this low inventory of available homes is keeping prices stable because, like I showed you, affordability is down, which means there's less qualified buyers, but there's also less to choose from. So if we, had 10 buyers and now we have 8, we've gone from 5 houses available to 3. And so we've seen a drop in available properties for sale, but we've also seen a drop in number of buyers. But right now, we're seeing that there are still fewer sellers than buyers. So it's still technically a seller's market, very much so. When you look at that inventory number of less than 2 months, that is absolutely, without question, a seller's real estate market. And the problem is a lot of these sellers are just stuck because they don't want to give up these loans with very low interest rates to borrow that same money again at a higher rate. And so it'll be interesting to see how this plays out. I think that when rates drop, we will see a dramatic increase in activity because I think there's a lot of people, people don't like to be stuck. They like to make decisions. And I think we'll see a lot of these people who feel stuck right now that want to make a move. So I want to just say, what is your guys' biggest question? And I think everyone has our information, but my name's Nick Krautter, and this is City and State Real Estate. We do commercial investment real estate in Oregon and Washington, and partner with Works Real Estate for all of our residential clients' needs. So would love to hear from you. Let me pull up. I'm going to stop sharing here and see, did anyone put something in chat for me? Or if you'd like, feel free to unmute yourself. And I don't think we see anything in chat. So you can feel free, if you have a question, to put it in the chat. And if you want to unmute yourself, go ahead and ask a question.
Hey, Nick, it's John.
John, thanks for joining us. Good to see you.
Absolutely, and good to see you. Great information. So it's interesting, going back to the downtown, residential conversion question, the idea. So, and I haven't thought this question out completely, but how do you resolve the Ritz-Carlton being able to sell $2.5 million, $8 million condos, and then the inability to, and maybe it's just structural, the inability to get these conversion projects off the ground or get much energy behind them? It would infer that there's demand. People want to live downtown, but why can't we get the structure in place?
So a couple things. If the Ritz-Carlton actually indeed sells out, which I'm suspicious that it won't, and if they're able to sell out at the prices they're asking, which again, I've had my opinion of that project is that Portland is the wrong market for a product at that price point. I'm happy saying that again here because I've shared that before, that I don't understand from my experience of the city and real estate, people paying that price per square foot. That being said, the amenity package that they're selling is incredibly high. And when you convert an office building, it's going to be more, depending on the scope of the renovation, it's going to be more bare bones. What I've been hearing from the people I know that have looked into doing it is that the cost for seismic and fire sprinkler and windows needed to convert buildings, assuming you even start with a building that's viable, which the big, huge square footprint buildings in downtown are not very viable because they're too far away from windows. So it's the older buildings, which unfortunately then you end up with older systems. So you're redoing elevators, roofs, seismic. You need opening windows. In a lot of cases, you need fresh air. So the conversions are just more, I think they're more expensive than people think. And so, I was hearing $350 a square foot. That article was quoting 225. I don't know if that's realistic or not. And it really depends on the building. Now, what would make it viable is if they removed a lot of the seismic and fire sprinkler requirements, and then they come into some kind of morality debate. And my take on it is, if people are currently living in older buildings without fire sprinklers and without seismic, and we all agree that that's fine. We don't have to like tear down a building every time the code changes, because that would just make no sense. Is it make sense to make a conversion that is built to that same spec, or are we not going to allow that? And that's really what's going to drive it. Or are there funds to fund it? The other issue is location. Like what, the number one thing in real estate is location. And I don't think there's a lot of people that want to live in downtown Portland right now. That's a specific to Portland problem. You go to other cities, obviously Manhattan, it's a different story, but even in Manhattan, people don't want to live in the financial district necessarily, or, or the lower sections of the business districts. They want to live in the Upper East Side, or they want to live in Midtown, where there's more vibrancy 7 days a week, as opposed to just during the business week. So I think it's one of those solutions that seems on surface really easy, and I'm a big fan of it. I just think that you have to remove so many layers of code and red tape to make it financially pencil, that without subsidies, I just don't see it happening. And the developers I've talked to, for how much time and money the city put into this program, which I think is well intentioned, it would make more sense just to create incentives to build new product, to allow people to build new apartment buildings and save money on the SDCs and the permits on those, as opposed to converting existing. Okay, so Mark Logan has a question in the chat. I don't see how cap rates are staying around 5 if purchases don't pencil with loans at 6 to 7. Yeah, so Mark, I agree with you, and I think that shows up in our sales numbers. We've had the lowest number of sales in the first quarter, and I bet if you analyzed all of those apartment sales, you'd see a lot of value add in smaller properties. Where that could work is if you buy a property with assumable debt, and that is starting to become more common. But even then, I've looked at 2 great properties with assumable debt, one of them new construction, one of them 90s built, and they're not moving. And so it's interesting, because if it was just a cap rate of return problem, those properties with assumable debt should be selling. And so that gives me concern that there's something else afoot beyond that, and that people are saying that that's the problem, but but there's something more to it than that, because the numbers still work. If you get assumable debt at 3.5% and you buy a 5 cap, that actually should pencil. Now the catch with assumable debt is how much debt is there and what is the asking price, and that's usually where you end up in trouble, is that usually that assumable debt is seasoned, and so you have to bring quite a bit of equity either way, regardless of the cash flows, just because the loan amount is lower than a new loan would be. Although right now, I mean, when you look at the numbers, I mean, 50% down, 60% down is not unheard of for a deal that's actually going to go through right now, just because the debt coverage ratios, based on the cost of the debt being high and the cap rates being lower, is pretty hard to overcome. But I think that's what I said. I don't really buy these projections that CoStar had in their reports that cap rates are going to stay in this 5% range. I think we're going back in that 6 range. Now, again, there's a huge amount of pent-up demand in the investor market, just like in housing. And if rates come down, I think we'll see a lot of people buy and sell. But until we see rates come back down, I think that there's going to be a lot of the market that's frozen. And the other thing that we're going to see is until inflation comes down, we're not going to see rates come down again. And so that, that 10-year treasury is still bouncing around between like 3 and 4, 3.5 and 4. And, it just keeps like, there's one report says that there's a recession coming and the rates drop, and then the next report says employment is up and the rates go right back up. So until we get some kind of clear trend with inflation, I think rates stay high. All right, don't be shy. I see a lot of smart people on this call. I know a lot of these names. What are some other questions? Or I'm going to start calling on people. Any other burning questions? Well, if there's more questions, ping quick. I want to thank everyone for joining us today. We wanted to make this kind of a fast and furious presentation. I didn't want to drone on for hours and hours. I appreciate you guys taking time away from lunchtime to join us today and learn this information and see this information. I would encourage you that, I think the long-term view, my long-term view of Portland is still very bullish. I think there's a lot of positives. I think we're going through a pretty significant rough patch. I think it's going to stay rough for a while. But remember, whenever there's a buyer, there's a seller, and whenever there's a seller, there's a buyer. And so there's a lot of people still making big bets and investing their money and time and energy in our community. And there's still a ton of people that want to be here. And I think that we'll see the future of Portland is bright. I think it's just going to be a rough patch. So, people buy and sell for a million different reasons. It isn't just about making money, or it's about what your business needs are, what your family needs are. It's about timing in life. We have a lot of clients reaching out, selling because they're getting to that retirement age and they don't want to have a portfolio of rentals anymore. They don't need the money. They don't need the rent. They're in a good position. So even investors make emotional decisions. And, we have a lot of people too that are selling their properties and moving their money to other places. Just like people are moving their money from California to Portland, a lot of Portland money is now leaving and going to other places. But again, every time someone sells, someone's buying. So we'd love to be here to help you. If you guys have a property you'd like us to analyze and give you a sense of the value and what it could sell for today, if you want us to look at your portfolio, your rent rolls, or help you and your business strategize for the future, we'd love to help. So please reach out to us, cityandstateri.com. I think you all have our information. Feel free to shoot me an email, call, text anytime, and we'll have recorded this. We'll make this available here in the future. And I appreciate everyone joining us today, and hope you have a great rest of your week and have a great year.